Hello everyone, I'm Todd C. Slater and welcome to this edition of SITV. Today I have a very special guest joining me. He is noted author, public speaker, and recently just released the book Profitable Practice. It is Mr. Timothy Brown. And Tim, thank you for joining us today.
Pleasure to be here.
So, one of the things that I wanted you to be able to answer, obviously for our viewers, is something that's very, very important.
Right.
What do you think of the traditional retirement plans and methods of saving?
So I guess, Todd, for the audience, we're talking about the RRSP.
That would be, of course. I just try not to put it under the bus, but I'll let you go ahead.
Well, I certainly have an opinion on this. For a number of years, my wife and I did bank on the traditional RRSP as a method of retirement savings. I think in the year 2011, which the RRSP season is closing today, roughly only 30% of Canadians made an RRSP contribution, and less than 5% of those people actually maximized it. So the question begs, do people not have the money to save for retirement, or are they looking for alternative forms of retirement savings? My personal opinion on this is that people are looking for alternative forms of retirement savings. When you make an RRSP contribution, there's a number of vehicles you can invest in, but generally that money ends up in the hands of Bay Street. And I think over the last 2 or 3 years in Canada and America, people have formed a different opinion about Wall Street and Bay Street and the people who manage our retirement savings. And I think the average Canadian is looking for something that's a little more familiar, a little more secure, such as real estate, of course, and something that they feel they can maybe, if they would choose to, have a little more active role in that investment, such as buying of the properties, selecting of the properties, and working with a firm such as yours to manage them for us. So I think Canadians have the money for retirement savings. I think we're shying away from the traditional RRSP because of the people who manage those funds for us and the fees they earn. The returns we've experienced in the last few years are inconsequential in my opinion. So Canadians are just looking for a better way to save for retirement, for income, and for asset value appreciation. And real estate has been the time-tested method for most Canadians and many Canadian families to save long-term, to save for retirement, generate generational wealth for their family and their children and their grandchildren. So I think really what people are saying is, we want to save for retirement, we just want an alternative vehicle. Let's look at real estate. And I think that's where your company has really struck a nerve in the Canadian public.
One of the things that I think a lot of viewers aren't aware of is also from an inheritance standpoint. When you take a look at your lump sum RSP,
right.
Okay, of course, that when let's say your children inherit your RSP, it becomes taxable that year as income. So do you want to elaborate a little on that?
Well, sure. So let's say a Canadian at 65 years of age has $200,000 or $300,000 saved in RRSP. If they've lived beyond 67 or 69, they have to convert that to an RRF, a retirement income fund. And so the late age Canadian would be drawing that out as income, and should they pass away, they then have to inherit that down to the family, and the government will pretty much claw most of that back in full taxable income at the time of inheritance. Whereas real estate's very different. I don't have to liquidate a real estate portfolio, or my estate doesn't have to liquidate my real estate portfolio. I can simply just pass that real estate portfolio down to my children or to my grandchildren. They can continue to earn the income from it, but they don't have to sell it. They can hold it. It's individually titled real estate, and that is generational wealth in its purest form. We can just pass that down through the generations. We don't have to liquidate it. We don't have to do a liquidation event under the rules of CRA, and there goes the RRF. Whatever my wife and I have managed to save, much of that will evaporate on time of expiry and time of passing. And I don't want to see the government capture all of that income tax right there. I'd rather see the properties and the value of that retirement portfolio in a real estate vehicle live on for the benefit of my children and my grandchildren.
So Tim, one of the questions that a lot of people have, of course, is when buying investment real estate, they're a little bit nervous, maybe a little uneducated on things. Perhaps, is there some advice that you can share with our viewers?
Well, sure. The first bit of advice I would share with the viewer is start small. There are many condominiums, for example, in Toronto is a perfect example. They're selling for $500,000, $600,000, $700,000. That is not the way to start in investment real estate. That is a substantial investment, a massive commitment to both down payment of upwards of $100,000, then a big mortgage of $500,000 or $600,000. I think the average Canadian needs to start small. Start with a smaller property, a manageable property. For example, condominiums selling between $100,000 and $150,000 can be purchased with $20,000 to $30,000 down. Many Canadians either have that money, maybe they chose not to invest in their RSP and they have the cash at hand. Many people could use part of their home equity line of credit to easily raise $20,000 or $30,000. And that's how you get started in real estate. Start small. The down payment is readily available in most people's personal finances, and buy one.
Well, you know, Tim, and that's a great point about your own home equity line, because for those of you that have not done it yet, the interest is actually tax deductible as well. So when you actually borrow from your home equity line, and let's say you use the full amount, $30,000 for a down payment, you can tax deduct the entire interest and all costs involved in purchasing that investment property, correct?
That's right. So, for example, if my wife and I were to borrow $30,000 from our home equity line and use that as a down payment into a condominium, very recently, several banks were offering 2.99 fixed over 4 years, and let's round that to 3% interest. Well, 3% interest rate on $30,000 is not a lot of money, and it's fully tax deductible by either our holding company or by the little shell we put together to buy and hold this real estate. That is a very, very small interest cost for acquiring a property upwards of $140,000, $150,000 in value. I think that the average Canadian should seek accounting advice if they haven't already done so. And I know that your firm has some spreadsheets and pro formas you're prepared to share with people, and they can certainly run that by their accountants. But 3% interest on $30,000 is not a large expense to acquire a property upwards of $150,000.
Yeah, it's perfect leverage.
Absolutely.
Well, Tim, thank you so much, because making that clear, I think, is important. Obviously, if you're thinking of investing, what avenue are you going to use? And clearly, having Mr. Timothy Brown join us today has been a real pleasure, and thank you for sharing your opinion with us.
Pleasure to be here.
It's been great to have you. So, folks, that just gives you a little bit of an insight on what the traditional retirement funds can look like, and perhaps there are options out there for you. So, thanks for joining us here at SITV.